Welcome to SilverOak's quarterly webinar. My name is Shannon King and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, partner as well, and our lead analyst. Today's webinar is scheduled to last 45 to 60 minutes, and a copy of it will be posted to the SilverOak website after today's session. If you have questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. And if you're not currently working with an advisor, feel free to contact me directly at 952-896-5701. I want to take just 1 minute and thank Jonathan and John and the rest of our SilverOak team for making the webinar possible, including the folks dealing with the technology issues. For compliance purposes, though, since I am the Chief Compliance Officer, I do need to note that in today's webinar, we're going to be discussing the overall markets and economy. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will also not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. But you should have received by now your quarterly performance reports. And if you have any specific questions, feel free to reach out to your SilverOak advisor if they haven't reached out to you already. And of course, we can't have any kind of investment discussion without saying that past performance is no guarantee of future success. Which the other thing I guess I should also mention is not only is Jonathan a partner and lead analyst with the firm, but today is his birthday. So he's the birthday boy for the day.
Absolutely, and somebody reminded me, since it's 2022 and my birthday is on the 22nd, that is my golden birthday.
There you go, and you're turning 22. That's amazing.
Yes, I wish I was.
All right, let's look at the agenda. As usual, the first section of today's webinar will be on economic data for the quarter. We'll then transition into the market data. We have an entire section today devoted to a discussion around recession risk, and we will be talking about inflation throughout the entire discussion today, including in the recession risk section. We'll touch on SilverOak's outlook, as well as some miscellaneous other updates and items. Of course, we do encourage questions. If you have any questions, as I mentioned earlier, reach out to your SilverOak advisor. If you even have suggestions for future topics, let us know that as well. We always encourage new topics, and we like to know what you're thinking about. So feel free to reach out to us about those items. So Jonathan, here we're showing the economy, and we say the recovery continues.
It does, but today we're also going to then review some things around in the economy that will and are providing some challenges.
So let's start with our market dashboard, which, as most people hopefully by now know, this dashboard is made up of 4 components. The economy, which continues to show it's in positive position. That's reflected by the green in the box for both the first quarter 2022 and then the projected 2022 second quarter. And by the way, green is positive. As I alluded to, red is bad.
Red is
green is good,
yep,
red is bad. Okay. The credit markets, the second component of the dashboard, remains good or in positive territory. Valuations, well, frankly, these have been a bit challenged for quite a while, meaning valuations are high. Market sentiment, we're showing this as the one component that's projected anyway to go from positive to negative. And then the overall composite, which even with market sentiment projected to go negative, the overall composite still remains strong. Any particular details here, Jonathan, you wanted to touch on?
Yeah, when we look at the economy, things have been really, really strong. So one of the things we'll show later is certainly housing has been strong, but with rising interest rates, we do think that factor will come down a bit. Employment has been really strong, which has led to wage growth, which is also now kind of impacting inflation. The market sentiment turning negative next quarter really is a reflection around consumer sentiment surveys, which have soured because of higher inflation. And then that factor also does look at recent market performance. And with the markets down, that becomes a negative factor.
So if we look at that composite, the market dashboard, over time, we can see here that the current and the 6-month are obviously shifting to kind of more of a downdraft versus kind of that upward sloping line. But I guess the one thing to add to that is that both of those are still kind of above what we would consider important thresholds, being more positive versus more negative. So the trajectory is definitely shifted, but they still are currently projected to remain in that more positive category. Now, as it relates to GDP, you said earlier from an economic perspective, things continue to grow. And that's really what we're seeing here with GDP almost back to the trend growth before the pandemic.
Yeah, so it's recovered almost to that 2% trend line, above kind of the pandemic level. But what we're seeing is that rate of GDP growth is starting to slow. And not surprising considering how strong it was, and you can see kind of the depths and coming back. So not necessarily a negative thing. This is what we would expect.
What about, though, more global growth? So this is US GDP. What are we thinking globally with regards to the economies?
Generally, global economic activity has been strong as well. So if we look kind of on the far right and look at February and March, we're seeing a lot of greens. Now, we are starting to see some yellows and some oranges. And so if we look, you're going to see down near the bottom in the emerging market sector that China is in the yellow and just kind of went below 50. I think that's really more of a reflection that growth slowed last year. And now we're dealing with those lockdowns in Shanghai and some of the other major areas. And then kind of at the bottom, Russia is very, very weak, not surprising with the situation and the economic sanctions. Japan is a little bit weak as well. Everything else is strong, but we're going to definitely want to watch that situation because, again, the Ukrainian situation is going to affect Europe. So we could see that weaken a little bit. And what we'll say generally is that global growth is still good and solid, but the IMF, for example, just lowered their global growth forecast by 1%. And so again, we're going to want to watch this global situation.
So back to the US though, I think one of the more encouraging things that I've seen, and that is the consumer. The consumer still remains very strong, and they drive 2/3 of the GDP in the US. So that's positive to know.
Well, right. Even before the pandemic, you're going to see that generally there was a growth trend, a slight one, in consumer savings. And before the economic recession in 2008, we actually had negative savings growth. But what we really want to highlight on the far right is the fact that during the pandemic, with stimulus, checks being sent to people, there was a big accumulation of cash. And in fact, the estimate is that it's still about $2 trillion. And so consumer balance sheets are generally in very good condition. And that, I think, has helped offset the higher inflation that we've seen.
Well, and with strong consumers, especially if they're out spending some of those savings that they've accumulated, that should translate into strong earnings, I would think.
Yeah, and so with the pandemic recovery, we basically saw an earnings recession of 1 year, and then in 2021 we saw a huge recovery in earnings, and that's really what we see in that blue column. And then the projection for this year is still reasonable growth as well as next year.
Now, for me, the one thing that I really kind of question when I think of these projected earnings growth numbers is whether companies will be able to achieve that in the face of what is pretty stiff wage inflation. But you're showing us here on this next slide that thus far anyway, it looks like companies have been able to pass through that wage inflation.
So far. So here we're measuring is the percentage of businesses that have raised wages and raised prices. And what we're seeing is that there really isn't that big of a gap. And in fact, the gap is that more have raised prices than wages. And so thus far, margins have held up in this inflationary environment for most companies.
So the real question is whether they'll be able to continue to pass that through, or if at some point this year they'll find some resistance, either with consumers not spending as much, which obviously would hit earnings, or companies just simply won't be able to raise the prices, period.
Yeah, absolutely. We saw this in the dashboard that while sentiment is souring, what we're actually still seeing is good spending growth.
Sure.
So far.
So back to kind of the big picture perspective, this shows our economic factors scorecard. And just looking here, Jonathan, we have two items that have negative and behind them. That's indicating what? That we've shifted them down from, let's say, like interest rates from positive to neutral, or commodity prices from neutral to negative?
That's absolutely correct. So interest rates moved one column negative because they've increased as the markets have essentially seen the change in Fed policy. And then commodity prices, again, were strong last year, but the Ukrainian invasion by Russia has put more upward pressure.
And unfortunately, we're not going to see any upward pointing arrows. Instead, we're seeing quite a few downward pointing arrows, which meant basically sentiment is weakening in those areas.
Absolutely. So monetary policy has a negative arrow. We know that interest rates are increasing. The Fed is going to raise rates. Credit conditions has a negative arrow. Essentially, we're seeing the yield curve flatten, which makes lending less profitable for banks and could impact growth. When we look on the negative side, we have a negative arrow in China. China was dealing last year with slower growth as they tried to combat the real estate bubble that they feared. And then more recently, we've seen some negativity due to the lockdowns, especially, we've all watched what's happened in Shanghai. Now, interestingly, when they reported Q1 GDP, it actually came in a little bit above expectations. But the negative arrow really reflects the potential risk that these lockdowns are going to have to the supply chain and growth going forward. Obviously, geopolitics was a big negative in the quarter with the Ukrainian invasion by Russia, and we've seen US inflation continue to tick up. The only other thing I'd mention on the positive column is fiscal policy and housing do not have negative arrows. We're likely going to see those shift downward or likely shift to the neutral column because housing prices have continued to go up, but we've seen interest rates go up, and so now mortgage rates are at 5%. And so I don't think it's going to be a positive influence going forward. And then obviously this year there's less stimulus, and so fiscal policy, I think, will be shifting to a neutral.
Sure. And back to that inflation, I know we say here in the negative it's US inflation, but frankly, we're starting to see global inflation. So that's not, a phenomenon just in the US. And a lot of that has to do with the supply chains. And we'll get into the issue in a little while about how much is transitory, how much is sticky. But let's talk about the supply chains and the global supply chains and the impact that's having on global inflation.
Yeah, so let's look at the bottom half of the slide. This is really a heat map looking at different factors within the supply chain and showing pressure points. So one of the things that we'll see is that it was in fairly good shape ahead of the pandemic and then essentially turned yellow, orange, and now red, reflecting just how tight things are. And if we look at the top half, we're really looking at a pressure index over time. And you'll see that things started to heat up a little bit ahead of the pandemic. But at one point we were more than 4 standard deviations above average within this index. And that just reflects how tight things are. Essentially think of a global supply chain that was in sync for years, that we threw a wrench at it with the pandemic and everything that ensued.
Well, and then back to the whole wage discussion. So, we talked about how wages could impact earnings. So far, it doesn't seem to be the case, but this is showing the fact that we are starting to experience some of that wage inflation that could be problematic, and back in the 70s or 80s did cause some problems.
Yeah, absolutely. So unemployment is back to where we were more or less pre-pandemic.
So that's the gray line on this.
That's the gray line. We know that, and this has been talked about by the Fed, that there's 1.7 job openings to unemployed people, and that's really the highest it's been. That potentially is what's adding to this wage pressure. But we're seeing wage pressure now above 6%. In the past 10, 15 years, 20 years, we tended to top out at 4%. So this is definitely different, more akin to where we were in the 1970s, but not yet quite there yet.
And we'll give in a few minutes why things maybe are different this time than what we did see in the 70s or 80s. There's no question, though, that we're seeing continued pressure on inflation from commodities, and that was in our dashboard or our scorecard as well. So what are we seeing here, Jonathan?
So on the left side of the slide, we're looking at some different global commodities, crude oil, gold, silver, livestock, things like that. And you're going to see that generally speaking, most of these commodities are in the high level. So they're kind of above that long-term median.
So that's the diamond in the dark box.
Correct. Yep. Okay. And then on the right side, though, we wanted to show what potential pressures are occurring because of the Ukrainian-Russian situation. And so Russia is a pretty big exporter in certain different global commodities. On the top, you'll see palladium being a very large producer, but they're also a decent producer of natural gas, potash, platinum, things like that. The orange you're going to see is the Ukraine, and they're actually a fairly large producer of wheat and corn. And so we've seen, again, those commodity prices come up, but one of the interesting situations with what's going on in the Ukraine is they're not planting. And so Africa is a big buyer of corn and wheat from the Ukraine, and many parts of Africa are already dealing with famine conditions. And so I think, unfortunately, it's going to get worse before it gets better.
Yeah, terrible situation. Obviously, from a humanitarian perspective, it's just an absolute disaster. Hard to see something like that happen ever. But you and I were talking before today's session started, and the timing of this war and all the ensuing items that are coming from it probably couldn't be much worse. Just as we were trying to get out of this supply chain issue with the global pandemic, now we've got these added concerns beyond, again, just the pure humanitarian disaster that's happening. So let's talk about what components of inflation might be more transitory. That's kind of a famous word these days after the Federal Reserve had used it maybe a little bit too loosely over the last year or so, and what components are maybe more sticky.
Yes, so if we look at the last bar on the right, the bottom half would be kind of sticky, the top half would be transitory. And so we know energy prices are up a lot, and certainly with the Ukrainian situation have spiked. We also know that over the last year or so, that the new and used car markets have been impacted by the shortage in chips. Those are things that over time can come down. That's really why they're quote unquote transitory. Food at home, is kind of another considered transitory item. Potentially at some point we might see food inflation come down a little bit. But the bottom half is really the focus, because if you look on the left, you're going to see that it was much lower and has been coming up. The issue is that during the pandemic, we've seen housing prices and real estate prices in general increase. The other thing we're seeing is with a shift in the pandemic, we're seeing consumer spending coming back to travel. And so the airlines have all, are, I would say, on the verge of profitability, almost back to kind of where they were, kind of similar in hotels. So we're going to see prices continue to go up, and those will be sticky. And so we're going to have to watch it. Now, again, we think that things will come down, but because these sticky items have been coming up, and I would say wage growth would also be kind of sticky, we might, while it might moderate over the next 12 to 18 months, we might be at a higher level than where we started the pandemic.
Sure. Well, and one thing that I was a little bit surprised about is on this next slide, how the component of our spending and how much we spend on food and energy, how that's changed over time.
Yeah, absolutely. So if we look on the left side of the slide and look at that dark line, which is food and energy as a percentage of consumer spending, back in the 50s, 60s, and 70s, it was well above 20%. And if we look on the far right, you'll see now makes up about 12%. On the bottom in blue, we're looking at energy. And so if we look at kind of that spike in the 70s, it made up about 9% of consumer spending. Now it makes up, 4%. Now it's up, but again, off a much lower base than the past. And so it has an impact in general on consumers, but just not as much as it would have 20, 30 years ago. Now on the right, we wanted to show kind of the impact of the rise in energy production over the last 10 or 15 years in the United States and that impact. So back in the 70s, we were importing a lot of oil from OPEC, and at one point it hit 3% of the economy. Well, right before the pandemic, we actually became slight net exporters of energy. And so that has a very minimal impact. And in fact, you could argue that inflation and high energy prices is actually going to help the US energy complex. And so that creates jobs and wages that helps offset a little bit the inflationary side of food and energy.
And this is one of the big items that I think people point to as it relates to comparing today to the late 70s, because it is quite a bit different.
Absolutely.
Now here you're showing that inflation is likely to moderate, and I know there may be some skeptics out there. It sounds a little bit like the Federal Reserve saying it's transitory, but what are we seeing here?
Well, here we're looking at, generally speaking, inflation going down over the next 12 months. We're not saying that it's going back to 2 or 3%. We're saying it's going to come down from the current high levels to something lower. Now, we have two cases. The blue line is basically showing if commodity prices remain elevated, we'll see it come down, but not quite as much. In the green line, what we're showing is commodity prices actually come down from here. And so, you know, in 12 months, we could see inflation below 4%. Now, with everything going on, and this is, again, the Ukrainian situation couldn't have come at a worse time, it's still putting that upward pressure on commodities. So I don't think that the green case is very likely. It could be something in between, or it could be closer to that blue line.
Now, of course, the Federal Reserve is beginning to shift their policy in a number of ways we'll talk about. But one of the most obvious that probably everybody has seen is the shift that they're making in interest rate policy and the Fed funds rate. So what we're seeing here is essentially what we think as we look out will be the projected hiking of rates over the next couple of years.
Yeah, and so we know that there was a 25 basis point hike in March. Chairman Powell has been out in the last day or two talking a bit more. And as we were talking before the call, his wording said that 50 basis point rate hikes were on the table. Now the market has actually taken that and priced it in more or less. So they think it's very likely both the next rate hike and then the second rate hike would also likely be a 50 basis point hike.
So with all of that, let's talk about the impact this has had on the markets. And we say here widespread weakness. If we look at the numbers, it will be quite obvious that the equity markets were impacted during the first quarter, with everything here being down. And that actually translated into negative performance in many of what we consider the higher risk equity markets for the 12-month trailing period ending 3/31. So small cap stocks, international and emerging markets, with really just the US and the US large cap and mid cap still having positive performance. Maybe what was most concerning for a lot of investors is not necessarily this, although I know people get a little freaked out when the equity markets go down. They shouldn't though, right? Because that's a pretty regular occurrence. I mean, usually in any given year, we have 5 to 10% pullbacks, intra-year pullbacks anyway, almost every year on average. And 10 or 15% pullbacks are not really all that uncommon either.
And this is on top of 3 prior calendar year returns of very strong.
Well, that's a good point. 20% or so plus each year of those 3-year periods. But I think maybe what caused people maybe a little bit more heartburn are the fixed income numbers. The fact that bonds were down almost 6% just for the quarter. And that has actually pulled down the 1-year trailing numbers ending 3/31 as well. And I think, you know, that's where people tend to have this belief that fixed income means fixed price or no downside or whatever it might be, only, you know, upside, no downside risk. But that's just not the way bonds work. And we'll explain kind of what's happening in the bond markets in a little bit more detail. But I also wanted to point out here the one number that's the obvious outlier to the upside, that's commodities. And I think, you know, people will look at this data and maybe jump to the wrong conclusion. And I don't know, Jonathan, if you've had discussions with clients or investors, but I think a lot of people would look at this and say, geez, you know, I missed out on commodities. Like, that was obvious that commodities were going to be up that much. So we included today probably one of my favorite slides of all time. I think we showed it either last quarter or the quarter prior. But this is really pointing out the commodities, they're coming off what I refer to as a very long winter. So this chart is a calendar year by column. At the top of the chart is the best performing asset category for the year. At the bottom is the worst performing, and each category is color coded. So cash is, I'm going to guess blue. I'm colorblind, but I think blue or purple. I know commodities are black or dark gray. Maybe green. I don't know.
Maybe dark green. Yeah.
Okay.
Yep. I was on the angles.
All right.
Yeah, dark green.
This one kills me. The point is, commodities over the last extended period of time have either been at the bottom or very close to the bottom in performance. As a matter of fact, even taking into account the strong performance they had in 2021, the annualized performance from 2007 ending 2021, they are at the bottom of all of the categories, while from a risk perspective or volatility perspective, they're toward the top, which isn't necessarily always the best combination of an investment you're looking for, high volatility and low return. That wouldn't be the type of investment we would necessarily be looking at. Now, no denying, they will occasionally have these strong periods of performance. So we're not trying to discount that, but we have to be a little bit careful believing that this level of performance is going to be continuing indefinitely, because history just shows us these are very volatile assets and they don't always perform quite as well as they have the last year or so. Now, going back to equities though, and we're going to focus first on US equities, we're saying here, Jonathan, that value stocks have held up better than growth stocks.
Yeah, absolutely. And a lot of that has to do with the underlying economic sectors. So not surprisingly, people know that energy has done well, and that really has been the biggest contributor to value doing better. Utilities have also done well. But it's also a story of other things not doing as well. So technology, communication services, and consumer discretionary have been down during this period, which has kind of led to the growth situation.
Yeah, so this chart, the left bar for each of the categories is showing the value component. So in all three cases, value outperformed growth on a quarterly basis. Now, the one exception as we look at the one-year numbers is in the large cap category. Large cap growth has still slightly on a one-year basis outperformed large cap value, but still values outperformed in the mid and small cap category. And we're showing here that valuations have come down, and I suspect that's a combination of, one, we've had kind of a pullback in the equity markets, but we've also had some decent earnings as well.
Yeah, so absolutely. Looking at year end, you're seeing that grayish to dark line going up. That's earnings. And then if we kind of look at the chart at the bottom, you'll see it's a growth rate of 4%. The S&P 500 is down a little bit less than 5% during this period, meaning that valuation or the multiple of the market has actually come down 9%.
Now, as we mentioned earlier, the international markets were all generally down. I guess there is one exception, kind of an outlier to the numbers.
Yeah, absolutely. So generally speaking, international's been weak. Latin America, though, was surprising. We looked into it, and it actually, they produce a lot of commodities, and so they benefited from the spike in commodity prices.
Now, the one thing we are seeing consistent between the US and the international markets is that value kind of tilt. So here we're showing the value versus growth performance for the quarter. At the far left is the international, kind of broad-based. In the middle is the international small cap, and at the far right's the emerging market category. And again, across the board for the quarter, value did better than growth. Now, doesn't mean that value was positive.
Nope.
but it did better.
It did
less worse.
Yeah, exactly.
Okay. All right. On a one-year basis, that is also generally true here across the board. Whereas in the U.S., we did see U.S. large cap on a 1-year basis, growth do is slightly better than value, but here across the board, value is pretty much dominated. So let's get into the discussion around bonds, because as I mentioned earlier, I think this is the one part of a lot of portfolios that caused investors maybe the most heartburn. And it's not a surprise to see some negative numbers given rising interest rates, but some of these numbers are 5, 6, 7%. They're pretty big declines.
Yeah, these are actually some of the biggest declines that we've seen in the bond market in decades.
Yeah. Now, we've got both quarterly and 1-year performance numbers, and it's pretty obvious the one that's positive is TIPS on a 1-year basis. Do you want to speak to that?
Yeah, that has all to do with inflation. So TIPS stands for Treasury Inflation Protected Securities. And so with the higher inflation, we've seen positive performance. Now, it was negative in the first quarter, but those bonds tend to have a duration or maturity length between 7 to 10 years. And so with the increase in interest rates, we actually did see that come down a little bit in the quarter.
And that might have been even a bigger surprise for some investors, because I know late last year, maybe very early this year, I had a ton of questions about going into TIPS. Everybody wanted to go into TIPS with the anticipation that was pretty much guaranteed there was positive performance there because of inflation. Yet for the quarter, obviously that wasn't the case. So give us a long-term perspective on yields and inflation, Jonathan.
Yeah, so we wanted to show kind of how inflation and interest rates and yield levels interacted over time. And so here we're going back into the late 50s. But in general, on the left side of the chart, what we're looking at were periods where inflation was actually starting to go up. And what we see is that generally speaking, yields tend to follow in inflation. And then you'll see kind of in the left of middle, kind of in the early 80s when inflation was broken through the high interest rates that the Federal Reserve put in place, we saw yields start to come down. And so that's generally been the trend. Now, recently, though, yields have come up first because of the economic recovery that started post-pandemic, and then because of anticipation of the Fed rate hikes. But with inflation at such high levels, we're actually at a very negative real yield of -4%. And that's one of the reasons why the Fed believes it has room to raise interest rates to break inflation. But what we'll likely see if inflation remains high, that we'll see generally higher yield levels.
So what does that translate, I guess, in layman's terms, into returns?
So here we wanted to show you how rare negative returns are. And in fact, during this series of years that we're looking at, we've only had 4 negative years. We've had high periods of inflation in the past, back in the 80s. And so that's the red arrows showing down. And so if we look on the far left, during the period we saw this higher inflation, you're going to actually see positive returns.
So just to clarify, the arrows that are pointing down just signify that year we had inflation over 4%.
Yes, absolutely.
And the gray area is showing the actual total return of bonds for that given year.
Yeah, absolutely. So if we go to the far left and look at that first column, that was a year of 4% plus inflation, yet bond returns were up 3%. And in fact, if we look at the 4 years in which bond returns were negative, there was actually only 1 year, a negative year with inflation above 4%, and that was in 2021.
Interesting.
So it doesn't necessarily mean that we're going to see negative bond returns even with high rates and high inflation.
And it's not unusual to see per se negative returns, at least intra-year. Maybe it's a little more unusual to see calendar year negative returns, but intra-year returns as the rate hiking cycle begins. But then with the higher yields, it makes up in the total return.
Right. Now, I'm going to say something that's kind of interesting. When looking back, we've actually never seen 2 years in a row of negative returns. But with what's going on today with inflation, the Ukrainian war, and the Fed having to fight inflation and raising rates to do so, we're likely going to have negative returns this year.
Sure.
So with the pandemic, we've talked about how the pandemic has made history. This is a history making event this year. But that doesn't necessarily mean that we don't want to be in bonds, because again, it doesn't necessarily mean the returns will be negative. And then the other from here.
Yep.
But it also doesn't really negate the case that bonds are a good factor in risk-off periods,
right,
holding up the portfolio.
Right. So with that, let's talk about this discussion around a recession, because I'm getting this a lot too. I mean, probably the two big topics, inflation and recession. So what are the factors that could go into pushing us into a recession? And we've outlined some of the big ones here. The lack of fiscal stimulus, which we've talked about. The reduction in the monetary stimulus, and the fact that the Federal Reserve isn't actually just raising interest rates, but they're going to have a runoff of their bond purchasing program, which we'll talk about next. We have these inflationary pressures that we've been talking about. I think the big one for me, frankly, coming back to the wage inflation and whether companies can continue to pass that on or not. And then, of course, the inversion of the yield curve. And if you're not sure exactly what we mean by an inversion of the yield curve, it just basically means that short-term interest rates move briefly above longer-term interest rates. So normally the yield curve is kind of upward sloping. This would be an inverted yield curve where it's downward sloping.
And this is potentially why a lot of people have questions, because there have been a lot of articles in the last 2 to 3 weeks about this. And we'll show this later, but it did briefly invert. And so a lot of articles online were published as a result.
Good point. Well, let's start with this discussion around the Federal Reserve. We talked about interest rates going up, but we didn't yet talk about the reduction of the balance sheet.
Yeah, so we have had periods where the Federal Reserve has bought bonds. It's called quantitative easing, okay? So they really stopped their purchases as of March. And then recently did provide more information that they are likely going to start letting bonds mature starting in May. Normally what they do is they reissue bonds. And so this will actually cause the balance sheet to shrink. And so if anything, that would be a quantitative tightening program. And so we've gone in the last 2 years of 120 billion of bonds being purchased per month by the Fed to likely, starting in May, 95 billion of bonds they're going to allow them to mature. And so that will shrink the balance sheet. And that's really what we're seeing on the far right in this forecast. And it's going to be both in treasuries and in mortgage-backed bonds.
Sure. So why is this such a big deal? I mean, we're talking about interest rates and we're talking about the reduction of the balance sheet, but why is there such a focus these days, Jonathan, on the Federal Reserve?
Because the viewpoint is that the Federal Reserve in past tightening cycles have caused recessions. So if we look on the far left, what I would say is that in 60% of the instances, that's been true. But it didn't lead to it in 40% of the instances. So there's a lot of fear around this, but it doesn't necessarily mean it's going to happen just because the Fed is raising rates.
Good point. And I think a lot of people refer to this as the soft landing, right? We're shooting for that 40% soft landing.
Absolutely. And the other side of that would be, they call it a hard landing. And so that's where a lot of this debate is going right now, is that will this be a hard landing or a soft landing?
So let's pretend it's a hard landing. Even in those instances, though, is it not the case that hard landing doesn't occur immediately. You know, as soon as the Federal Reserve starts shifting their monetary policy, it's not as though that month or even that quarter we go into a recession.
Yeah, absolutely. And so in the middle, we look on the that right, far left bar in blue, you're going to see average. 30 months is the average onset from the Fed starting tightening cycle to the beginning of the recession. Now, if we look to the far right, we're actually then going further and saying, again, let's assume that this is a hard landing and we're starting the clock as of March. What that would mean is that we could have 24 months further where the market could go up. Literally in the past, the average time to S&P 500 peak is roughly 2 years. And the average gain during this period is actually 36%. And then kind of finally, you get to that 30 months where the recession begins. And the other thing I also want to remind people is that the recession is called by the government after it's actually started. And so the market side of it is a little trickier. And so this idea that just because they started raising rates in March, we should get out of the market now. You could miss on a lot of potential upside because there are just a lot of factors involved. And again, there's that 40% of the time where we had the soft landing.
Sure. So you had made reference to the inversion of the yield curve. I think I even mentioned it as well. So this is showing us the inversion in March of 2022 relative to what it normally looks like as in December of 2021. Explain though, kind of why this really matters.
Yeah, it matters because in the past, when the yield curve becomes inverted or the short end of the curve has higher yields, it's led to less growth. Why? Because banks, essentially banks borrow with short-term rates and then lend to consumers and businesses in the longer term situation. So if they're borrowing to lend at a higher level than they can actually earn, they're not going to do it.
Sure.
And so that is what has led to slowdowns in the past. And so that's the concern. And we don't know whether that inversion that happened briefly will cause this. And again, full disclosure, it was only inverted for a couple of days. But that has brought up kind of all of this concern.
Right. And I guess, you know, history isn't necessarily repeating, but it does somewhat rhyme. And so here we're showing in red the periods in which we've had inversions in the past. And then it's kind of hard to see, but there's shaded areas. Those shaded areas then show the period of the recession that hence follows the inversion.
Yeah, and a couple points. It's not a perfect indicator. There have been several instances where it inverted and we didn't get a recession. And then the other thing I'll also mention is that during periods of high inflation, it can be giving a false signal, which is one of the thought processes right now. But if you look back to the late 70s, we saw a very deep and long duration of these inversions. And so I think that is something that we need to think about.
Again, another difference between back in the 70s versus what at least we've seen so far.
Correct. Now, we can't just use one indicator to really get a better feel for recession risk. And in fact, we've even talked about how the 2s and 10s have been used, but there are other yield curves. And in fact, the Fed looks at the 3-month versus the 10-year, and several other major economists do as well. That hasn't inverted. So here we're looking at a diffusion index that was created using 12 different yield curves. And essentially, the evidence is that when that level reaches 90% or greater, that means that that inversion is actually meaningful. And so if we look on the far right, our current situation is that we're in a low probability. We're at 25%. Now, it is higher than it was a couple months ago. but it's still far less than where we really need to be concerned at this point.
And how about the market indicators?
Yeah, so we've talked about how you can't look at one indicator. We can't just look at one yield curve. And then on top of that, we need to look at other indicators in addition to the yield curve. And so this is another diffusion index that adds some leading indicators and coincident indicators. And so if we look at the far right, the dark blue diamond is showing our current situation. So it's a higher risk than it was even a quarter ago, but still far below risks that we've seen in the past. And then the light blue shaded diamond is our current situation, which means are we potentially in a recession right now, those coincident indicators. And it's signaling clearly that we are not. So not a high risk yet.
Wow, that was a lot of information, Jonathan. But I think what would be useful now would be just to talk about our outlook and, taking all of what we've discussed into account. What do we think is going to happen both in the U.S. and international, first from an economic standpoint and then from a market standpoint. So here we've pretty much taken the position that the expansion is likely to slow and frankly probably is slowing. But we don't believe to recessionary levels, at least not yet. Now, the one thing that we can guarantee, there will be a recession. That is normal in the economic cycle. It's just when that recession occurs is anybody's guess. Nobody knows. And even the government, as you pointed out, always calls recessions after the fact. And that's the way economic data works. But we are seeing a slowing, but not likely again to the recessionary levels quite yet. We do think inflation will be persistent throughout 2022, but hopefully then will moderate over the next year. We've already talked several times today about the fiscal and monetary shift in policy, but I just can't reiterate enough how well positioned the consumer is. And given the consumer is driving 2/3 at least of US GDP, that is something to not take lightly. Internationally, the global recovery is definitely being challenged. War in Ukraine, as Jonathan mentioned earlier, has reduced everyone's expectations of growth there for the next year or so. China continues to be a headwind, as you pointed out earlier in today's discussion, and they also are facing tightening fiscal and monetary policy. So what does that mean for the markets? What do we think is going to happen, Jonathan, in the equity markets?
Well, there are no guarantees. We do believe we'll see higher volatility. We've seen it this year, but with just this difference in potential outcomes, the market is going to be watching data points, and so we'll be watching the consumer. The Fed could potentially overshoot, and again, that is the concern, is that to combat inflation, they might raise rates too high, and then that does push us into a recession or that hard landing. As we've talked about, so far, earnings growth has been good, and that's been because companies have been able to pass on price increases. But the question is, can they continue to do that? We've talked about this in the past. We've seen value doing better. We also feel international is undervalued relative to other areas. But obviously, with the challenges this year, international is not likely going to outperform, but it still is an opportunity long term. Yields likely to continue rising. Now, again, the markets have somewhat anticipated the future Fed increases, so it doesn't mean that the 10-year Treasury yield is going to go up to 6% from here, but likely to increase. And we've also talked about the risk-off protection that bonds are likely going to continue to provide, although we're in a situation where bond returns are going to be relatively modest, we believe, long term.
Now, hopefully, some of those returns will turn back at least positive with the higher yields that we talked about earlier. And eventually, higher yields will incorporate into the total return of fixed income.
Right, and that's a great point, because from where we are right now with yields, you know, bonds provide that risk off protection, but with this higher yield level, if you were to purchase bonds today, your likelihood of having a positive return is much higher as a result.
Well, I went back, and I think it was in early 2021, we really started advising that bonds were likely to provide less total return. Now, at the time, we generally thought somewhere in the low single-digit range. Last year, they came in slightly less than that. I think the overall bond market was down 1.7% or something of that nature. A lot of our bond portfolios were actually up about 1%. But nonetheless, we did start advising that those total returns would come down. Given the significant pullback that we've seen in the bond market, I would anticipate at some point, especially with the rising yields, that we're going to start increasing our expectations of total returns. Not today, probably not in the next quarter or couple of quarters, but at some point we will start looking at this being a kind of value opportunity going forward. Other SilverOak updates and items. So IQs, this is our investment quality scoring system. Overall, our IQs positions did well with the 12-month period ending 3/31/22. In particular, our value-oriented positions did well on an absolute and relative basis. Although, Jonathan, we did have two growth-oriented positions that were just frankly significantly off their benchmarks. One in the U.S. large cap growth category, and its sister position in the international growth category. Why generally did we see those types of positions off their benchmark so much?
Yeah, we didn't mention this before, but especially in the US, we saw the top 10 tech companies do extremely well. And these funds being diversified, especially the US fund, not owning as much of these top 10 tech names, that impacted it. That also had an impact on the international growth fund as well.
Okay, and we also had one emerging market position, and I've had this question a couple of times. It did get hit due to some kind of indirect China exposure, Asia exposure, but it also came into the year with a 5 to 6% allocation toward Russia, which obviously pretty much got written off given the events of the last month or two. On the flip side, our addition of real assets in most of the portfolios added to absolute performance. On a relative basis, being a little bit underweight international relative to the overall stock market, that helped, as did having a more diversified bond portfolio. And, you know, although looking back, it would have been great to hold more tips over that 12-month period of time. That opportunity may have passed, as we saw with the first quarter performance of tips coming down a bit. And that's frankly somewhat our concern on commodities. I mean, commodities may have more runway, but we do know that they're very volatile. And if anything, they are not proxies for bonds. So people that are looking at their bond portfolios saying, hey, they're down 3, 4, 5, 6%, and commodities are up 20, 30, 40%, maybe we need to shift some of our bonds to commodities. That would be a major shift in risk profile that you really need to be cognizant of. Other noteworthy items. If you bought I-bonds in 2021 based on some communications that we had and sent out, essentially suggesting that you consider doing so given their rates, well, every year you can buy another $10,000 worth each individual. So if you did it last year, now that we're in the new year, you might want to consider doing another $10,000 worth. And then, of course, you may be hearing about the Secure Act, which is passed now through the House and is more than likely to pass in the Senate. What does this do? Well, it's going to expand auto enrollment in 401k, 403b plans. It's going to offer a savers credit expansion. But maybe more so for some of our clients, it's going to increase the RMD age, the required minimum distribution age, from 72 to 75. That's a big increase given they just a couple of years ago increased it from 70 and a half. If you have any additional questions or again topics that you want us to touch in future webinars, I highly encourage you to reach out to your SilverOak advisor. We're always entertaining that conversation. If you're not working with a SilverOak advisor, my phone number again is 952-896-5701. So with that, I'd like to thank everybody for taking the time today to join us. And again, Jonathan, happy birthday.
Thank you.
Have a good day.